Okay, welcome to this roundtable. In this case, is market disruption. The topic we are going to be talking: artificial intelligence and investments technology. Actually, this is a topic that I like a lot because, especially in my case, in Lorenzo's case also, so we're investing a lot in AI, not only as a thing that this is kind of private equity investment. So we bought a company that invests in these kind of things and develop these kind of things. But additionally, regarding the investments side of things, in our case also through this company, so we were working a lot to develop models, agents that are able to manage money and allocate money. The point is, for me, in my case at least, is that so far, this technology is it's having a great breakthrough. We see that it's evolving a lot. It's able to manage and to allocate pretty good assets, and it makes abnormal returns. So it is happening, but it is not able to think so far. And there's in the investments, in value investing, at least as I understand value investing, there's these two areas: the quantitative side, where I can study data, tons of data, and the machine is able to do it, so much faster than me and very likely much accurate. So this is one thing, but the other thing is the qualitative side. So for me, it's quite complicated to understand that if I wanna, for instance, imagine that we are attending a conference call and the manager is delivering this speech, and we can see and we can capture the the conservative language, and we can relate this conservative language with a value company. So it might be a possibility, it might be a way to identify qualitatively value investing companies. So I have a question. The first question that I have is for Brent Worth. Brent Worth is the CTO of Substrate AI. It's a company that develops these things. Actually, it's the company I was talking about. And Brent Worth is the guy that has been programming and developing these agents, not only for finance, but other things also. So in this case, the first question, Brent, is, do you think this possibility, this qualitative side of things are, or other way, I'm gonna throw the question in another way. Do you think we can understand or we can use AI to invest by using value investing as Warren Buffett did, or Benjamin Graham, or these kind of things, by combining these two things, these two areas, the quantitative side and qualitative side? Do you think this is possible? Or do you want to see it?
To be quite honest, I think that even qualitative is still quantitative, because there's some way to measure how you're trying to make some kind of decision regarding an investment. And if you have some structured way in which you can actually make that qualitative assessment, okay, to be basically pulled together with some kind of quantitative background, kind of like a technical analysis, this is, I think, a natural blending. And to be quite honest, it's quite possible. I haven't actually done it yet. Mostly because it's mostly just trying to get that structure, that data, so that you can actually make some kind of numerical, some kind of quantitative. Sorry, you're gonna hit it.
Sure.
Assessment on it. So yeah, it's quite possible. It's not easy, and actually, there's a big concept about I guess alternative data sets, and this is probably part of that qualitative data space that you're talking about, and that's a very big and up and coming thing. Very expensive too.
I can bet. But in that case, it's interesting what you say, because if eventually qualitative can be quantitative, because it's measurable. So I have a question in this case for Wes Gray. So Wes, you are a quantitative guy. So in your case, you're value investing. You're a value-driven guy for sure, and quantitative driven guy. So what I see is that when following this kind of systematic ways of investing, also Tavi, because Tavi also in the macro models, but it's a quantitative model. So eventually the idea is that we are collecting data and we are putting all together, and we allow a computer to suggest us a suggestion to buy. So that are meeting the criteria that we want. So what I see in this case, it resonates a lot with me, because it's like when we are talking about AI and this kind of quantitative way of understanding, do you think we should embrace AI as a quantitative investors? Because in my case, I'm also a quantitative investor. I'm a little bit, I have a mess. But anyways, what I do know is that in the quantitative side, I don't know, what's your take on this? Because for me, I think we should embrace this as a quantitative investors.
Sure. So, I mean, I embrace anything that systematizes decision-making, just because you can rip out, monkey brain problems. So, I'm obviously a huge fan of anything that just makes you put a rule book in place. But then it's a question of like, well, what are the tools available and are they effective? And then probably a more important part that a lot of people forget is, can this be communicated and stuck with through thick and thin? So to answer your original question, like, should we embrace and look and explore, machine learning, new techniques, new data? Well, of course we should. That's great. And we've done a lot of that. Frank, we've never found anything that really adds much marginal value, but let's just assume we did, right? Let's just assume we found some black box, machine learning algorithm that, is better at estimating fundamentals that could add value. To the extent that it didn't work all the time, and it wasn't just my capital, I would need to be able to communicate the how and why of this thing, or it would be very difficult to get your capital to stick with these damn things. So I'm a huge fan of all technology and all data and everything, but at some level, it also, unless it's like Rentec where it just makes money every day, if it has a bad period, it would be important that I could educate and communicate my capital holders of how this thing works, or inevitably, if it has a bad run, the great technology will get liquidated, just like anyone who has a bad run gets liquidated. But presumably a human or like a simple like model that people can get their head around, they're less likely at the margin to blow out versus some black box. That'd be kind of the trade-offs that I would look at it all through.
Well, that's interesting because in my case, it's something that happens to me. If I try to explain what happens with the models that I'm testing out, it's like, actually, I don't know exactly. So I understand many things, but I don't know the reasons the agent is cherry picking a specific bunch of stocks. So it's quite complicated to explain it to your investors, for instance. It's quite complicated. So this is a thing that is true, that is a problem. It's a real problem. In my case, it's a real problem. So it's interesting that you notice this, because it's maybe something that we have to explore and try to see how to ask to the computer to explain us what it does, the process. I don't know if this is possible, Brent. Later on, I will ask you, but that's a possibility.
I actually do think that is possible. We're working with the group that's their explicit objective. I told them, I was like, hey, they're doing like all this, they're all a bunch of math PhDs in Canada, and they're actually doing a lot of like fundamental machine learning stuff where they're not using the canned Python package. They're like building the actual source code to do their own machine learning algorithms. But I told them, I was like, listen, I'm happy to partner with you, especially if this thing works. But then we need a way to communicate this and explain to people how this works in as well as we can, just to give them confidence that it's not, some Ponzi scheme or whatever. So there's definitely groups working on the education part of machine learning, I think. It's just going to take a while.
It's super interesting, the point of view. I'm going to write it down because for me it's important. So excellent. Yeah. Very, very nice. Okay, so I have another question in this case. I wanted to ask about this environment. I mean, what I see, I'm a value investor. Okay, this is the first thing. Okay, and I see that the market is, the technological side is skyrocketing. So we see the Nasdaq coming up a lot, and we see many other themes that are the gold. For instance, Tavi is investing a lot and Crescat is killing it actually. So they're making a lot of money. So this is a thing that is happening, and there are different themes that are great themes, especially now. But I see also that this technological breakthrough is like there are many things at a time that are occurring now at a time. Is so like piling up different disruption in this innovation that is coming. For instance, AI is one thing, but also the digital wallets, also the genomics, also in the healthcare. There are many other things, where the autonomous car, for instance, these kind of things that are piling up, and this is something that is changing a lot. We saw recently that, for instance, in the digital wallet, that is something that is fighting against the banks. It's like in 10 years, 10 years, it has got, there are two companies, Cash App, for instance, Cash App has reached 60 members, 60 million of users in 7 years. But JP Morgan took 30 years and 5 acquisitions. So something is happening at a very high speed. So the coming years, maybe over the next 10 years, 15 years, 20 years, that we invest because we want to make money in that time. So we have clear that this idea of long term, and in our case, we have it clear. So in that case, I see the future totally different. For me, it's like I don't know if you know this book that is called Real. I think it's called Real Player One, and you see a total disruptive world that might happen. Might happen. So, or even this Brave New World of Huxley. So, how do you? In this case, this question is for Christopher Dembick, okay? So how do you see, Christopher, the coming, given the situation, the macro situation that we have, the problems that we have, not the problems that we have now in the short run, they are gonna get solved or maybe not, but in the long haul. So how do you see the world, and what do you think are the things that are gonna be totally disruptive and are gonna change a lot regarding the world that we know today?
Well, I think that it's always a bit tricky to know what's going to happen in the next 5 or 10 years. But I think at least as of now, we know the biggest trends. It does not mean that it will happen, that you will have new economic sectors or that it will really disrupt the economy or the way we live. But as a matter of fact, I think that we understand from this crisis that companies that can use digital very well are the biggest winners. So the trend that was a pre-COVID trend in the way that you had all the digital companies that was already performing quite well, I expect they will perform even much better in the coming years. And we are moving toward this kind of monopoly, oligopolies in some very specific areas with new technologies. But on top of that, I think we could not forget that there will be this biggest trend, I think, in terms of policy will be green investments. We have seen that green investment, especially in terms of US dollar funds, was performing quite well during the pandemic. But I think what we need to understand is that politicians will put so much money in terms of green investment. I don't know if it will be successful or not, but as a matter of fact, you will have a very big economic sector that will develop in the coming years. As you know, Saxo Bank is a Danish bank originally, and the Danish stock market actually has been performing extremely well over the past quarters because it has a very strong exposure on green investment, green technology. So I think that we cannot forget that it will be one of the biggest trends that will shape the economy in the, let's say, 5 or 10 years. And on top of that, there will be obviously all the issues with healthcare, aging population, that we will need to take care of this aging population. I think that it won't be a quiet road because we know that economic activity, we should understand that we cannot probably reach economic activity above 2% growth in the long run. So it means that we need to also create a society where we are able to share wealth and to reduce inequality, knowing that we don't know what will be the exact path for inflation, but we know probably that we won't have so much economic growth in the coming years. So it's very tricky, but clearly I bet that new technology will perform quite well, especially medium caps that are popping up in the market. They will probably perform well in the coming years. But for me, one of the biggest trends will be clearly green investment. Personally, I'm still very skeptical. I'm not sure that it will evolve, it will really change our life, and we will be able to face climate change and all the transformation. But I know that politicians will put a lot of money in that, but green investment are usually performing well, at least over the past quarters. So this is one of the biggest trends, I would say, that we need to pay attention in the coming years.
Interesting, Christopher, interesting. I have, given this, I mean, if we give this for granted, this question is for Tavi. So Tavi, in your case, now your models, because you especially use these kind of macro models to put in practice the macro analysis. So the themes that you see now, what are the disruptive themes or trends that you see dominating the markets over the next years? Now in the short run, of course, I see that you're very clear. It's the gold, and you're shorting even the stock market, so the equity. So why, and what is these disruptive themes that you see dominating the markets over the next years?
From a disruptive perspective, I think the credit situation we've had has probably reached an exhaustion point. And so the debt burden in the economy in general should start really impacting real growth, economic growth that I'm referring to. So I think the big trend certainly is the monetary debasement, in which the monetary stimulus will certainly continue to be used, in my view, to fund a lot of fiscal stimulus. We've had, here in the U.S., a twin deficit, something we haven't had in a long time in terms of the level of imbalance in terms of that, in which it's largest than any other period in history. I think that all will have issues with the race to the bottom for fiat currencies. And hard assets will become, the new, in my view, the new asset class that needs to get more attention. Hard assets would include commodities. There is a major reason why we haven't seen inflation today. One of them is what you're referring to a lot, which is the technological advancements. But also, I think the one major one is the commodity prices haven't really risen in the last 10 years. And that certainly is a more than anything, in my view, a major reason why we haven't seen inflation. I think the world is going to look very different if we do have commodity prices moving higher, and will probably trump a lot of the other issues with money velocity or technological advancements that certainly are deflationary, at least the declining money velocity aspect to it. I think that will be a big change. And in terms of ways of looking at markets, I think the low inflation and cheap cost of capital in general has allowed a lot of companies to survive in the environment that they probably wouldn't survive in sustaining lack of profitability and bleeding capital for so many quarters, you name it. And so many, actually, a lot of tech companies are in that scenario, and other companies too, in industrial sectors and all sorts of sectors we're seeing that sort of behavior. I think that if we do have commodity prices moving higher in the following years as part of what I see of a macro trend, a major macro trend, being initially started by precious metals, which was what we've seen so far this year and since 2018, really. I think that will change, especially the investment environment, in which investors will begin to really look at profitability. Profitability has been out of favor, believe it or not. No one looks at profitability anymore because of cost of capital. It's so cheap. You can sustain those money-losing business models for a long time. So I think that if that changes, the setup will also be an inflection point for new fundamental metrics, not new, but fundamental metrics that have not been used in the previous years. everyone is really focused on market share and revenue growth rather than the bottom line. And that's fine. That worked really well in the last decade or so. And the question is that really what is going to, are we going to sustain that path in the following years? So my view about precious metals is, I mean, I have so many reasons behind, as you've seen some of my writings about this. But I believe strongly that not only the macro environment, but we've seen a lack of investments in commodities, which is going to cause clearly to me a mismatch of supply and demand. Demand is probably not, it hasn't really changed, and perhaps is even going to increase going forward. But the lack of supply, new discoveries, exploring budget at all-time lows, this is all going to have a major implications in the near future in terms of that mismatch of supply and demand. So, that's all putting aside the situation where we are in terms of the debt cycle, the credit exhaustion period that I think we reached that inflection point here with asset prices at record levels. It creates a thought for a lot of investors to look for alternatives of investments that are maybe have been out of favor for so long. The miners being a great example. Anyways, that's the way I see the world today in a very brief way. But I think there's a lot of positive things that will come out and a lot of opportunities. And the monetary debasement, in my view, is a major one that I think there's no way out of this besides really inflating our way out. I'm not an inflationist or a deflationist. I'm seeing this on the picture of literally monetary debasement going forward, which could certainly cause inflation as well. So I think there will be a lot of interesting plays. And I think also there is a cycle. When you begin the cycle, you have the value investors that do really well. And then the market goes up, keep going higher. The growth investors come in. And then it's the quant guys because the market never goes down. And it becomes, I'm not going to say easy, but it becomes, markets just go up and then the quant guys become in favor again. And then markets get a little wobbly, and the macro guys become now the new guys, and so everything is sort of within that cycle of the actual economic cycle, in my view. Even different types of investment approaches. But anyways, that would be my best way to answer that question.
No, totally. In this case, there's a thing that comes up that is okay. If we have. I mean, at some point, all of us think that the inflation is going to come at some point, maybe sooner or later, but it will come because it's a way also to wipe out this debt that is skyrocketing a lot and eventually, so maybe it's something that happens, and taking positions regarding that it's clear. But there's another thing that is technology brings abundance and deflation, both at a time. And now this, I think this catalyst, if we force, we know, but if we force the deflation, in this case, technology would bring abundance and would bring cheap prices, many things that comes with the deflationary environment. So how do you cope with this idea? In this case, the question is for Christopher again. How do you cope with this idea? What happens if instead of coming inflation, the deflation lasts, 10, 15 years?
Well, to be frankly speaking, I'm very skeptical that we could have deflation for the next 10, 30 years. I mean, I see many ways that we will move toward higher inflation. And I think what we need to understand is that this level of debt, in the short term, obviously, the level of public debt is completely manageable and central banks are buying as much as they want on the market. But let's not forget that at one point, it cannot last forever. And especially sitting here in Paris, we know that with European Central Bank, it is very clear that at one point the German won't allow the European Central Bank to buy all the assets on the market. So frankly speaking with you, I don't think that we will have for the next 10 or 15 years deflation. We have deflationary structure of the economy because of new technology, aging, etc. But as a matter of fact, I think the biggest risk for investors is that from one day to another, central banks, but also governments, will understand that the only way to deal with the high level of public debt is to have a little bit of inflation. I mean, it is clearly what has done Germany after the Second World War. It was much higher, but let's say that central banks and governments allow inflation to move around 3-4% maximum. I mean, it will have an impact already on investment on many citizens as well. So I think the biggest risk, and everyone is understand this risk in the medium term, is to have this spiking inflation, but we don't know so much how to mitigate it. But I think that at one point we need to understand that we cannot allow to have so much debt, public and private debt, that it is negative for the economy at the end of the day. So we will need to face a situation where we need to cope with that. And as I told you before, I don't expect that we will move to much higher level of economic activities. So it means that the easiest way for me is to move towards higher inflation. So deflation for me is the longer trend, I will say, and we know what is the structural trend, but it does not mean that we could not have, I don't know, like a 2, 3, 4 years window where we have higher inflation. And that's, I think, the biggest risk in the medium term for investors.
Mm-hmm. Okay. And okay, so thank you. And the next question is for Jeff Graham. In this case, Jeff, if we see the value investing from a classical point of view, okay, so we are using value investing and we want to buy these companies with a discount, okay, so especially if it's a mature sector, it makes sense. If the growth rate is steady, so I can forecast the free cash flow or project it, or I mean, it's a thing that I can manage. And I remember back in the day, I don't know, 15 years ago, something like that, I was analyzing a company and I could say, okay, this company, it belongs to a mature sector. I understand the company. So it would resonate with this idea of value investing, okay? But now I see that the very company, maybe let's say a cheese company, okay? Something like that, okay? It's also escalating technology. So I remember there's a fund manager here in Spain that is super famous, that is called Francisco García Paramés. And this guy is using the classical approach, value investing classical approach, and he has done it very, very good. You know, this is one thing. But lately, and he says that he wants to keep buying the same things as always. He's not performing pretty good lately, but he also say that he doesn't use WhatsApp, for instance. So he's not coping with the real world. This is just my opinion. So what I see is how do you cope with this situation? Now with a company, the same company that we were studying now is escalating technology, is escalating AI, is escalating these things. And what it was a mature sector or company, it was a business, super clear. Now it is not anymore. It's a technological company also. And technological company and value investing not always get along. So what's your take on this, Jeff?
Yeah, I mean, to me, it's very exciting. You know, when you think about classical value investing, there are kind of two key tenets. Like the first is that, you're hoping to buy the business for less than the kind of intrinsic value of the discounted future cash flows. There's that element. And then there's the element that, that you're not going to get influenced by the short-term fluctuations of the market and that you're going to look out for the long term. And, embedded in that idea is this, notion is in that, markets aren't as good at, valuing business for the long term. It's, very short-term focused. Like I talked in my discussion with you about, even if you look at something like Alphabet, Google has like 50 to 60 sell-side analysts, very few of them, only 5 to 10 of them have the courage, like to publish, a 3-year projection. And so the really, those kind of two key aspects of, the value principles, kind of highlights why things are hard now, but exciting. And like the first is that clearly, the growth of a business is a key part of your valuation. Like you can't just bank on finding a bunch of mature, dependable performers to build your portfolio around. Like to really, I think that lots of guys in my position, lots of people who do fundamental investing, like a lot of, what we're doing is evaluating growth prospects, because that's a key part of the valuation in business today. And I think it's that long-term view, like, as you point out, just like, the economy is so dynamic right now. Competitive dynamics are so difficult, and the repercussions of falling behind are so damaging. And it's not just that, like, it's damaging from the business perspective. Now, from the investor perspective, if you're wrong on growth, then you get killed. And if you're wrong on your long-term view, you get killed. Whereas, maybe 20 years ago, you're looking at USG, and if your 5-year targets are a little bit off, like you might not get hurt that badly. So to me, it's very, like exciting that we have this, dynamic economy right now.
Yeah, totally. No, actually, it brings me another questions, in this case for Wes, because, the other day when we were discussing, Wes and I, about his point of view, about your point of view, Wes, you were talking about value and you were talking about momentum at a time. I mean, both two things that you could combine, In that case, for me, what Jeff is saying, it makes all the sense. Growth is part of the idea. In your case, Wes, maybe you use momentum, but I guess through momentum you are going to capture many companies that are actually companies that are coming up due to the growth of the company that is growing a lot. So it makes all the sense. And there's a way to deal with these dynamics. I think this might be a way to deal with these dynamics. What I don't understand, and this is a question for you, Wes, is you study and you have studied a lot quantitatively, many things. Currently, this trend that is growth can be fueled due to the technological side, for instance, okay, or many momentum stocks. Are momentum stocks due to the technological, because they belong to the technological sector. So this is happening now. And would you use, for instance, if a company, this is something that should be started, I don't know, I think that it would be interesting, but the question is, do you think that screening, filtering the market, and drawing a black line and saying, okay, if the company is escalating technology, I'm going to take it into account, and it is not escalating technology, AI, whatever, I'm not going to take it into account. Do you think this might bring us abnormal returns?
I think it's probably unclear. So a lot of times, honestly, like growth is usually overpriced through the market because of sentiment issues. So that's why if you run like a momentum portfolio, for example, you have to like have high turnover, because if something loses its momentum, you'll get your face ripped off, right? Whereas a value, it's kind of a slow play, like fundamental anomaly. So maybe you rebalance that once every year, every 3 years, every 5 years, you'll still see some potential benefit there. So I would say that, like, if I'm a fundamental value investor, like in the sense of like Buffett, like it doesn't matter if it's cheap or expensive. I'm trying to just figure out like what's the net present value of the cash flows and compare that to the marketplace. And that obviously includes like a growth component in the future and like current earnings. I mean, I don't do that business anymore, but I can just tell you from like a systematic evidence perspective that the ability to estimate better about growth prospects in the market is you're usually wrong and usually overpay, is what I know what the average effect is. Arguably that's driven by like human, monkey brains, like over extrapolating everything. But who knows, right? Like, maybe people have gotten better at calculating, forecasting, or maybe the market's underappreciating, the growth prospects or monopoly power of Amazon. I don't know. I just know that historically and knowing human beings that's probably wrong on average, because they tend to extrapolate good news way too far, probably more so than they should. So, but who knows?
Okay.
Maybe you could.
No, it's clear. I mean, my idea was, what I'm, trying to understand is that in this new economy, in this dynamic economy, taking into account the companies that are escalating these technologies and these ideas, maybe they're able, in average, to grow much more eventually. I don't know, because it's something that I've not studied, but it's something that it would be interesting to have as a filter, very likely I mean, to be able to screen. But I don't know if you
people
have
do
any
that with like R&D expenditures all the time, or you can even do like there's an old paper at some Harvard buddies of mine. I can't remember what the heck it's called, but you could just look at R&D dollars, or you can actually look at like success of R&D. So you can someone could put R&D dollars in. You can actually see subsequent growth rates, and you can say, hey, let's only focus on R&D investors who actually aren't just CapEx destroyers. And all these things seem to kind of work at the margin. The issue is, the price. You got to still worry about what price you pay. And when you start looking at like R&D expenditures and people that invest in future growth, the problem is like the PE ratio is not exactly 10. It's usually like 10,000. Right. So that's always a challenge. How do I find like an amazing, high quality, free cash flow machine who's investing in great R&D that's lower than cost of capital, that's also cheap? Well, yeah, good luck with that. That's impossible on average.
Yeah, that's clear. The price that we pay, of course, that's important, and it has to be added in this analysis. Do you think, Jeff, that because you were talking about buying and evaluating a company as Alphabet, for instance, or Amazon or whatever? So in that case, what do you think about the price that we pay? Is this important? Even you are buying growth or you are buying future value?
Yeah, it's important. I mean, look, I think the bottom line is, I think that Wes made like the most important point of as he is executing his investment, strategy, a lot of it is built around avoiding the monkey brain that drives the market and taking advantage of it. And, I'm not a quantitative investor like he is. I'm a qualitative investor. And, the interesting aspect of that from my perspective is I'm trying to do the exact same thing of, everything about my investment style is built around, trying to stay rational and trying to avoid doing dumb things. And to me, the result of that, for me is that, my investment style over time has become more and more qualitative. I can't remember the last time that I did a spreadsheet. And I think what that speaks to is that, we all have our little ways, to try to beat the market. And, as you point out, there's, there's all of this. I mean, I feel like we began the discussion today with, harnessing technology as a part of our investment process. And I think the key point there is, it depends on kind of where you're coming from, right? So for me, it's it's always been a very qualitative approach. And then the fact that you have all of these very powerful and successful quantitative tools that in some ways I'm competing against, it's kind of driven me even further into qualitative investing. Yeah. And I would guess that quantitative investors are kind of being driven further into refining their strategies, and harnessing, this extra, technological power at their disposal. And, for me, one big challenge is I feel on the data front, we now have a situation where you have this huge amount of, payments data, credit card data, social media data being pulled, like Expedia searches, all this stuff that's being, will harnessed by investors. And so for me, it's like, can I do what I'm doing and ignore that stuff? Like the answer is, well, probably no, because like I have to kind of keep the playing field as clear as I can. And I try to kind of have this long-term view that allows me to kind of like have a differentiated long-term investing style. But I can't invest in a retail company if everyone around me is, getting, real-time credit card data and I'm not. And so like, I think, one key question like that you've been touching on is, well, how do we harness these things? And for me, it's less using this stuff to kind of, like build a new advantage. It is just to keep the playing field flat and allow me to kind of continue down my old qualitative long-term path.
Yeah, gotcha. And there's a thing that I'd like to ask in this case to Bren, because if I try to figure out a model, or in your case, Bren, if you have to figure out a model to implement AI in the macro side of things, imagine that we wanna create a model to help Tavi Costa to invest in the macro themes. Okay, he's an expert modeling this kind of macro themes, and I have another question for him later. Okay, but anyways, he's an expert about modeling these kind of macro things. But how we could? Sorry.
I said I would love his help.
Let's try. So imagine that we should help. We have to help him to model and use this technology, this AI technology, into the macro models. How would you do it? I think you have to. Yeah, that's it. Come again.
Anyway, the first thing is it's always data, and the second thing from my perspective, I work a lot in reinforcement learning. It's kind of like my bag, and is timescale. Okay, timescale plays a huge role in the kind of strategies you can implement and the kind of algorithms you want to use. And so from a macro perspective, okay, we have ways of getting data, okay, but it occurs on a time frame, okay, that we have to understand that the trade recommendations we make, okay, defines what our recommendations would have to be compliant or compatible with the time frame which they're actually interested in. Okay, so it's not like I can use macro information and expect to be useful in a day trading or high frequency trading type environment. That's not the case. Here, it could provide you some layer on top of a overall strategy, okay, from that allows you to kind of create a color field where you can say, okay, maybe I understand that there's some value aspects here that I can combine with like growth value. I don't know if that's a thing, maybe not, but where you can see that maybe some value products or companies can become maybe growth because they're starting to adopt more technology, as Jeff alluded to. And this is kind of like timing things. But you really have to understand the time scale at which the data can inform your decisions. And I think that's probably the only thing that's the big thing you have to understand.
If solving that would be the cutting edge. If you are able to solve that and to apply it in that
Oh yes, and I think it's quite doable. Okay, but you have to understand that I don't think any investment strategy is one arrow at a time. Okay, you have different arrows that have different capabilities. It's like kind of like playing like these different mobile app games that have like the different cards of different players. That you're going to make a combination of these capabilities and timescales to create your overall strategic trading plan, and as well as it actually gives you confidence. Okay, it's not just simply executing the trades. It also gives you the confidence that, say, Wes, like from a quantitative perspective, that I'm making these short-term trades, but you know what? Maybe there's some things that move against me. Having these longer-term contexts that are also quantitatively informed will allow me to say, you know what? I don't have to get scared. I just know that it's going to recover. Okay, it's just a short-term blip. Okay, And that's, I think something that has to be kind of considered in your entire repertoire of technologies you employ.
Absolutely. Okay, so I have the last question for Tavi in this case, and thank you guys, because for me, I'm collecting a lot of information, and I hope I can apply it also because my brain is also, like Wes said, stupid brain all the time. So this question, Tavi, is, in your case, you are co-managing this successful hedge fund, and now we were talking about investing by using value, using growth, using different approaches, and buying cheap, etc. But the point is that also you are using short. You are shorting equities, you are using options. So what's your take on that part? Why and what do you do to benefit of this other? The other flip of the coin, that is the shorting companies.
Well, first off, I couldn't agree more with what Brent said. I think short is something that a lot of investors have been avoiding, rightly so. And I know it very well because we've had shorts throughout the whole year. They worked really well at the beginning of the year with the crash in March and February, but since then, a lot of our shorts have gone against us. And we are okay leaving that as part of, or we usually build our portfolio across 15 macro themes, but they all evolve around 3 major high conviction ideas. In this case, being a big fan of or trying to understand the business cycle as a whole, we believe strongly that there is still assets in general is still mispriced for the depressed fundamentals, and fully understand the other side of the coin too, as the justifications of why assets have reached such overvalue levels in general. I think that the short part of her book has been very useful as a hedge of or long precious metals positions. And the issue with building macro models and creating systematic strategies, in my view, is that correlations change. And right now, I view the whole idea of buy gold and sell stocks, which is a very simplistic way of explaining what we are actually doing in our portfolio today, given the complexity of how, I wouldn't say highly complex, but certainly a level of complexity to the way we implement those ideas. And the short part of the book has been, in my view, critical to moments like we had in March. And I think it's still very possible. When we're talking about inflation, the bigger question for inflation or deflation, in my view, instead of precious metals, is for the equity investors. Because I don't think valuations deserve to be where they are if we do have inflation. I think if there's one market that needs to be repriced, it will be the equity markets immediately. So that's a big question for all equity investors, in my view. But it's a very difficult environment and endless process of evolving your macro models to understand what is likely to be the next correlation trends that we may see. And our view here at Kreskin, and by no means I think that this is the best way to approach investing in general. I think there's so many different ways that are very successful. It's just the way that we found that maybe we have an edge by doing that, but it doesn't mean it will work for other people as well. But by sort of building so many different models with the idea of what is, trying to give a score to the business cycle. Where are we and where have we been for the next few years? And what are metrics that have worked in the past to kind of predict this real big changes in the cycle? Understanding liquidity as a priority of in my view of the macro indicators, and try to not overfit your models too is another huge part of the problem. So anyways, I think that when I set the cycles of investment approaches and all that, I tackle that as not as a bad thing. I think there's there's different approaches that work for different people. And in my view, trying to align a lot of approaches that perhaps could work according to your investment strategy. In other words, we use a lot of quant models. We're still a very discretionary shop. We still use the human brain to come up with our macro themes. But I think that those are incredible tools that are unbiased and very interesting add to our investment process in general. Value investing, I don't think right now it's being out of favor. I think it will be, in my view, along with macro, one of the next new approaches that will be now in favor, given this profitability issue I said before. And there's always a space for growth investors, and I think that technical investors too, as searching for momentum in all the trades that we put in our portfolio. So going back to your question, the short part of the book is a very important part. I think a lot of investors acknowledge the long-term and short-term imbalances we have and the issues we have and more in the macro sense. And a lot of people have been avoiding really positioning themselves accordingly. We at Crescat that have been doing that. We have had success and sometimes it didn't work having the short part of the book. But I think it's a very important part of it that we're probably not going to be shying away any going forward as well. It's the buy gold and sell stocks idea. I think it's a medium-term trade. I think gold and precious metals will continue to outperform stocks. And if I really would like to position that in a way that I can profit from this, I think the best way is to be long precious metals overall and being short stocks and looking for a very selective basket of companies that really have those overvalue metrics I was referring to before.
Mm-hmm. Okay, it's clear. And I think we have covered an interesting rainbow of things that I wanted to ask you guys. It's been a pleasure to have you in this event. Actually, either the presentations that you ran or this roundtable, it's been a pleasure for me to have you on. And I hope we can keep in touch with you and learning from you, because actually this year we have done it. So we have interviewed you in different moments. So we have learned a lot. And here we are having this event at the end of the year. So I hope next year we can again do something like that one way or another. And for our audience, enjoying your presence in Spanish, because this is going to be dubbed. So you guys are going to be, all of you, talking in Spanish. So this is going to be super fun for us and for our audience. So thank you guys. And I hope you have enjoyed also. Thank you.